All right, we are in mode, which means we're about to get started. Cool. All right, let's get the magic happen. So we're here this evening. We're gonna talk about and how it's going to help get your retirement going. Um, hold on. Let me do this real quick. Do 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 do. Okay. I got everybody in presentation mode now, so I'll take it off presentation mode once we do some Q&A. So if you got any kind of questions or whatnot, put them in, type them in the chat box for me. So we want to get on tonight, and we want to talk about investments. One of the things about when we talking about investment is we want money to be working for us. So this way we won't be using majority of our time and labor for earning money. So that's the reason why I wanted to try to put this investment training together, so that way we can get a good warm and fuzzy for ourselves how investments work. So that way when we go out and we talk to others, we have a good confidence level when it comes to investing. Real quick, let me get out an announcement real quick before I start off with the webinar training. On November 7th, mark your calendar. November 7th, we my econ will have their monthly training, but it's going to be some couple of it's going to be some something real big going on that particular day. So on November 7th, if you can make it out, if you're in the driving distance of Atlanta, Georgia, right? Try to see if you can make it out there. What they're going to go over is they're going to roll out some new comp plans, bonus, talk about the new bonus, some new products, some online marketing. I think we're going to be looking at some new gold and platinum promos. And then, of course, they're going to do the regular BPM at 12:30. So what we're going to do is try to make it your best to come out, listen to those, and find out what's going on new with your my econ business, and then and of course get some training going on as well. All right. So that's the announcement. That's the only announcement that I have for right now. So let's go ahead and dig down into this. Let's go ahead and dig down into this investment training. So when we was talking about in the 369 transformation or what have you, we talked about those four obstacles, right? And so those four obstacles are inflation, tax, debt, and big business, right? And so when we're talking about overcoming those obstacles, right, those are the things that's preventing us from having a positive cash flow cycle. The first one we have to be able to overcome is that inflation. And so let's look at inflation, right? So inflation is that silent income killer that we always hear and grow about, because the price of goods and services is always going up, but our income stays the same all the time, right? So we have to have something in place to help outpace inflation. Think about it this way. The inflation rate, and you can pretty much just ink it in, but your inflation rate pretty much fluctuates in between the rate of 3 to 4%. Okay? And so when you look at it, right, you want to have something that's going to outpace that inflation rate. What's the best way to doing that? Is to have money working for you, because of the fact that you can't work money fast enough to beat inflation. And so the best way to do that is to have it in an income producing asset such as investments. Okay. And so we're gonna get into why we invest, what investment does for us, and how it's gonna set us apart when it's time to retire. Okay, so let's dig off into it. All right, so what's our purpose for training tonight for investment? What is our main purpose? So this is our main purpose here. We want to be able to understand what is all about asset accumulation. We want to acquire more assets so that way our assets is going to work for us. And this where it puts us in a position where money is for us to where now we just used to working for it. We flip the mentality of saying, let me get an asset. Your business is an asset. Okay. And also you want to continue accumulating assets. There's a concept that you always hear, cash, asset, cash, right? Basically you taking some cash, could be from your W-2, you take that, you plan it into an income producing asset such as a business, and then now your business will get you more cash. Now you just repeat the process, right? You take the cash from your business, put it into another asset, which is investments, to where now your investment will get you some more cash. We just keep repeating that process. And that's where asset accumulation come in at, okay? That's where the asset accumulation come in at. And here's the concept that's right out of the Bible right here. Proverbs 13:11. Wealth gained hastily will dwindle, but whoever gathers little will increase it. Okay? So we have biblical instruction when it comes to finances. Okay? And that's the reason why in Deuteronomy it states that God given us the ability to create wealth. Okay? So, this is not. So why do we? Well, let me ask the question. At what point do we say we no longer need income? And that's a question that we have to ask ask ourselves each day as we get up and we go about our day-to-day business. At what point do we say we no longer need money? Okay, it's kind of hard to say that we no longer need money because we don't live we live in a capitalistic environment where it requires us to spend money, so we will always need money. Okay, so why do we invest? Because we invest because with the expectation of us not working for our entire year or our entire lifetime. But when we stop working, we have to still have some kind of income coming in when we start work. We are ready to tackle the point where Social Security won't be there. Okay, 401k will be there, but from the rise and failures of the company, right? So we need something else that's going to allow us to generate some income for us. That's where the investment come in at. Later on in the presentation, we'll go over some of the different types of investment that we can accumulate. Okay, but the main reason why we invest is we're not trying to work our entire life, and we want to have some assets that's going to be working for us in our retirement years. Okay, that's the main reason why we invest. So how do we invest? Well, there is formula. This I wouldn't say it's secret, but it's an old formula that being used to double your money. Okay. Well, how old is this formula? Well, I tell you this. It's so at Albert Einstein. And now, so it goes back to Albert Einstein, and he discovered the rule of 72. And in his own words, right, um, he said, out of the way. He basically said that it's the greatest mathematical discovery of all time because of the fact it's an income generating tool that's going to produce it with little efforts. So what that formula does is it will calculate, right, how much your money grow in so many years. Okay, we'll go over the formula here shortly and how it works. Well, while we talking about how it works, there's two things that's required to make it work. Your earnings and time. This is where you heard from Brian and others that say that money is measured in time. And then in this case, that's exactly the case here. Money is measured in time. So, what is that? Okay. So yes. So when we have the ability to take money that we're earning, a portion of it, and put it in a vehicle to where now that vehicle is helping you generate money without you having to put forth an effort, that's leveraging your assets. And over the course of a time, when your assets accumulate and it generates money, now you to make big ticket purchase instead of using your labor that you're earning that you use your labor for you earning your income. Don't use your labor. Don't use your income from your labor to make big ticket purchase. Let your assets do that. We was at Game Changer this past weekend, and Brian Bean had walked up to the dealership and paid for a brand new car cash. And that's the point where we all should try to strive to be, where we're letting our assets, we're using assets. And by him doing that, now everybody in the car dealership want to know what he's doing. So it's just your habits, all right? But the habit starts with us wanting and willing to have investments, so that way investments are for us in our retirement years, all right? All right, so now let's talk about how the Rule 72 works. Some of you all have been in strategy sessions before and seen this secret or have on webinars or whatnot. It's about Banker Secret. I'm just going to go over it real quick, you all, just so you can see how it works. And that way, I'll show you later on how we go about finding investments, all right? So, the Banker's Secret. And all the Banker's Secret is they use what you call the Rule of 72, right? They use the Rule of 72. So here's the formula, all right? All you have to do to find out how fast your money doubles, you'll take 72 divided by the interest rate of your annuity, which will equal your money double in so many years. Okay, so we got three examples down here at the bottom. We're gonna go through this real quick so you can see how that formula will plug in. All right, so we got three guys that first guy gets 4%. All right, your second guy gets 6%. and the third guy gets 12%. All right. So let's go back to the guy for the 4%. So if you want to figure out how many years your money will doubles, remember 72 divided by the interest rate. All right. So let's look at the first guy. He has 4%. If we want to know how many years it's going to take for his money to double, we just do 4. And in his case, it's going to double 18 years. All right. The guy with the 6%. All right. How many years his money is going to double? Same thing. So in his case, his money is going to double every 12 years, and the 20% is every 6 years. Okay. Let me stop. Go ahead and allow some folks to ask any questions about what you see thus far as how the rule of 72 works. Hold on. Any questions? I just took y'all off of mute, so if y'all want to go ahead and ask any questions, feel free. Hey, listen, while I'm on the subject, right? These webinars, the reason why I'm doing these webinars, live webinars, I want it to be interactive, right? I want to be able to allow folks to ask questions, because most of the webinars or training that you'll see and hear, majority of it is, some of it is presenter only, to where you're not able to ask questions. Here, I want to open it up to where everybody can ask some questions, because this way now you can get your questions asked and at the same time get an answer in return, so that way you don't walk away from the presentation still with a question mark in your head. Well, what did he mean by the rule of 72? How he gonna get 6 years and the other one get 12 years? So don't be scared to ask any kind of question. If I can't answer the question, I definitely will. We have a network of folks to where we can get your answers, right? So if I can't immediately answer your questions, I would definitely take a note of it and get the answers, look it up myself or ask, and provide the answers to you. But I want this to be interactive, so don't be afraid of not asking questions. The question that you don't ask now could cost you later. All right? I just wanted to put that out there. So if I don't see any questions on this, we're gonna go ahead and move forward. All right? Cool. All right. So let's see how investments work. Each one of them are going to get $10,000 to start off with. Okay? So we're going to start with this first guy here. He starts off with $10,000. Now, his money is going to double every 18 years. So look at age 47, how much he get in 18 years. $20,000. All right? So the next 18 years will be age 65. So at age 65, his money would have grown to $40,000 with a 4% rate of return. Do everybody see that? Do everybody understand that? That's how investments work. Okay? Whatever you start off with, in his case, he's starting off with $10,000. His money is going to grow 18 years increment, so it doubles every 18 years. Started off with $10,000, the next 18 years, 20, and then the following 18 years, $40,000. Okay? Next one. Let's look at the guy with the 6%. All right? He's going to start off with the same $10,000 investment. Okay? But his money is growing every 12 years, or his money is doubling every 12 years. All right. So he started off with $10,000 at age 29. All right. Age 41. Look what happens. His money's double at age 41 at $20,000. Then his money double again at age 53 at $40,000. Now look at the difference right here. Well, let me just go ahead on with age 65. So age 65, $80,000. So automatically you can see the difference in just the 2% interest rate difference in between guy number one, guy number two. So guy number two has $40,000 more in retirement than the first guy because of his interest rate is 2% higher. Okay. All right. So the guy with the 12%, last guy, he's starting off with $10,000 at age 29, just like all the rest of them. But his money is going to double at 6 years. Okay. So look what happens at age 35. $20,000. Age 41, $40,000. Age 47, $80,000. At this point, he's at age 47, and guy number one is at age 47. Look how much more money his money has grown because of the 12% rate of return already. Okay. At age 53, $160,000. Look at guy number two. Guy number two ain't had but $40,000. This guy here got $160,000. So that's $120,000 increase or more. All right. Age 59, $320,000. And lastly, he gonna hit the retirement age 65, $640,000. So look at the comparison with the guy who has a rate of return of 12% versus the guy with 4%. Big difference. Big difference. Big difference. Okay? But that's how the rule of 72 works. Now, I'll tell you this. It's a formula that your Federal Reserve uses, okay? Your Federal Reserve is your governing body for banking industries. So guess who uses the rule of 72? Banks. That's why they call it the banker's secret. This is what the banks use as far as how they grow their money. All right? But we on the other hand, we need to flip that to where now we need to implement the rule of 72 in our own life, in our own daily practice, to where now we're earning 12% or better. So to where now we're getting 640 some thousand plus in our retirement. Okay. So here's the thing. While banks are using 12%, they're offering us 4% in the form of bank products. And I'm going to go over that in the next few slides here. But while we as customers getting 4% from the banks are taking our money that we deposit into their banks or products, and they reinvest our money. And they're going out there and they're getting 12%. They just know something that we don't. So basically, putting your money or leaving your money in the bank is a $600,000 decision. Okay. Now, does the bank the bank products have their purpose? Yes. Everybody need a checking account. Everybody needs a savings account, right? But those checking and savings accounts are typically nothing more or useful for us for a temporary holding spot. Money goes in, and money should go to somewhere else to where it's going to work for you. And I'm about to show you how how Wall Street is broken down into 4 quadrants, okay? And you'll see later on why you don't want to keep your money in the bank, okay? Any questions? Any questions on the rule of 72 and how it uses a formula such as this to double your money? Everybody's off mute, so if you got any questions, or if you got any questions, put it in the chat box. Go ahead and do that as well. All right, hold on for a second. Oh, okay. All right. So this is how Wall Street is broken down, okay? It's broken down into 4 quadrants. The first quadrant is cash equivalent. All right? Cash equivalent is nothing more than what the banks use or what the banks offer customers, right? So this is what makes up the first quadrant. Okay? These are your typical checking, savings account, CDs, bank money markets, market funds, broker CDs, saving bonds, U.S. Treasury bills. One thing to note, bank products, you pretty much will not get a rate of return of 2% or better. If anybody is using a bank product such as any of these that you see listed and is getting 4% or better, please let me know right now. I tell you one right now. I have a CD, or I'm about to get it converted, but I had a CD that I had for about 15 years. We had about $1,000 that we opened it up back 15 years ago. And over the course of 15 years, I've only, as far as maturity on that CD was only $147 out of 15 years. That's how much money has grown since I had it in 15 years, right? Why? Because the rate of return for that CD was 0.67%. So in essence, my daughters or my daughter's children will never see that money grow substantially because of the low rate of return. And that's what you get from the banks. Banks do not offer any products that's going to help your money grow. Okay? And so that's the reason why we say that you can't get rich putting your money in the bank because of the low rate of return. All right? So cash equivalents, they use for short-term usage. They're accessible every 24 hours, within 24 hours rather. But your rate of return is less than 2%. All right? All right, the second quadrant, stocks. So this is where all your stocks are. All right? Pre-initial public offerings, IPOs. Then you got IPOs. Then you got your secondary marketing, and then you got your marketing cap. Your pre-IPOs is where stocks are just being produced early in the stages, and you can buy them at a real low cost, on the pennies. But only certain folks get in on the front when they first develop. That's what they call pre IPOs. By the time it gets to us, as far as the general public, then it becomes IPOs. But then at that point, the rate of return is up as far as, or it costs more to get stocks when it becomes IPOs. Okay, but that's the difference between a pre IPO and an IPO. IPO is open up to the general public. The pre IPO is only open to certain folks, initial public, which is a small community of folks. Okay. Now I didn't put this disclaimer out there, but let me go ahead and just say I am not a financial advisor whatsoever, but I'm financial savvy enough, and we should all be, because of the fact I sit in on Ivy's training, or I just do some self educating myself, and so we all should be trying to do the same thing. But I just wanted to make sure and let y'all know that said ain't no financial advisor, okay? So the stuff that I'm showing you all is the stuff that I got or I learned through some training, all right? So that's quadrant number 2, all right? So in this quadrant is a little bit different, okay? This quadrant here is set up long term. It's successful within, your money is successful within 2 to 4 business days, but your rate of return is 8% or greater. All right? Your rate of return is 8% or greater. Any questions? All right, moving along. Your third quadrant. These are your bonds. Oh. Y'all have to excuse me. This slide here didn't get updated. But you have U.S. Treasury bonds, mutual funds, and things in this nature in quadrant number 3. And I don't understand why this slide didn't get updated. Okay, so y'all excuse me on that. These can be used short term. They are accessible within 2 to 4 business days, and your rate of return is 5% or greater. In the Millionaire Summit, in the investment training that we were in with Mr. Ivy Stokes, one gold nugget that he gave us was, if you have some money built up in your savings, because one of the strategies that he teaches us is build your emergency fund. Okay, and so in the best way, as far as the gold nugget that he gave us, the best way or the fastest way to do that is, instead of having your money parked in a savings account to where you're getting a low interest rate of return, you can use a municipal bond, which falls up under here, and use it for the same purpose as a checking and savings account. Reason being is, look at the rate of return that you're getting. It's 5% or better. So wouldn't you rather have your money growing at 5% or better versus 2% or less? I think that's a no-brainer. Okay? So that's quadrant number 3. Quadrant number 4. Now we're talking about real assets. Okay? Everything here is considered real assets. Okay. Real estate property, private business, collectibles, arts, and then cattle, gold, oil, etc. These are what you call real assets. All right. So these are long-term assets. Same here. They're accessible within 2 to 4 business days, or maybe even sooner, depending on what type of assets here that you accumulate here, like real estate. Depending on how that project and that deal, you can that money can be turned around a little bit faster, depending on how you work it. Okay. And we can safely say the rate of return is varies in between real assets, but they're going to be 8% or better. All right. So as a recap, these are your 4 quadrants: cash equivalent, stocks, bonds, and real estate. So here's the point that I want to make here when we're talking about these 4 quadrants, right? Your money, your money is going to work for somebody. The question is, who is it going to be? At the end of each day, the market will close, right? And at that point, when the market closes, the money is reallocated for reinvestment purposes. All right. Here's the thing. Quadrant number 1. If your money is sitting in quadrant number 1, your money is not going to work for you because of the low rate of return. Okay. So the best thing to do it is to have when the market closes each day is to have your market in the other 3 quadrants: stocks, bonds, or real assets. And this is why we need to get into a habit of accumulating assets to where our assets is in quadrant 2, 3, or 4, not quadrant 1. Okay? Just think about it this way. Your money is going to work for somebody. Shouldn't it go to work for you? Okay, Larry just asked a question. How do you go about obtaining municipal bonds? Good question. As a matter of fact, I'm getting to the point to where I'm going to show you to where you can go find those rate of returns of 8% or better. Okay, so that's a good question, Larry. All right. So when we're talking about quadrant 2, 3, and 4, you earn an income, and it comes out of 2 different sources. One is dividends. This is what a dividend is. It's a sum of money paid regularly by a company to its shareholders. All right. The other form of income when it comes to investment is capital gains. Capital gains is nothing more than a profit from a sale of a property or from an investment. So when your money is in either quadrant 2, 3, or 4, this is how your money is being returned back to you in the form of dividends or capital gains. All right, in the form of dividends and capital gains. Okay. So I leave everybody with this statement here. All right. If your money isn't working for you, it simply means it's working you. And that's a true statement. But we got to change that. We got to change it, and then we got to help others outside of my econ wall change the mentality on that too. But we have to first understand it. Okay? All right, any questions? All right, real quick. Well, I'm gonna open back up for questions. Let me go to where you can go get or rate of return of 8% or better, okay? So here's where Mr. Avi Stokes, if you ever had a one-on-one investment training with him or sat in one of his investment webinars, he teaches this all the time. And so here's the key when it comes to investment, because investment is not hard. I used to think investment is hard too. But here's the key thing about investment. If you know the inflation rate is 4% and you're trying to outpace it, then you want your assets to double the inflation. So that means you don't want to invest anything that's 8% or less, because if you don't, then you're not seeing your money grow. Case in point, if you know the inflation rate is 4%, but you put your money in an investment with a rate of return of 4%, are you seeing your money? You're not, because you're not outpacing inflation. So you need to be able to outpace inflation, and the best way to do that is to double the inflation rate. So that the easiest way to understand investment is, all you need to say in your head is, I want an investment vehicle that's going to be 8% or better. Anything less than that, I'm not going to be able to outpace inflation. Okay? Now, for those who have talked to financial advisors and you heard them say, well, there's no such thing as getting anything better than 4%, or if you heard them say, what's the other one I'm trying to think of? They can't guarantee 4% or better. Now, by them saying that statement, as far as them, they can't guarantee, because even though they got Series 6 license, they cannot guarantee, because they don't control the market, right? So they have to say that. But if you hear any investment advisor, financial advisors tell you that there's no such thing as finding investment of 4% or greater, that's not true. That's just an educational thing, and I'm about to show you. Okay. One of the when you're talking about getting getting your money and putting in an investment, right? You want to have someone that's going to work on your behalf, which is called excuse me, which is called money market firms, right? So T. Rowe Price, Fidelity, Vanguard, those three right on top of my head are money marketing firms, to where they go out and make your money go work for you. Okay, so you don't necessarily have to have a financial advisor. It's good to bounce ideas off of them, but if you understand that you don't need anything, you want any kind of investment that you have, you want it 8% or better. If you know that, then now you know what you're looking for yourself. Okay, so you can use either one of these money marketing firms, T. Rowe Price, Fidelity, or Vanguard, right? They all got their own set of portfolios. For this example, I'm just going to use T. Rowe Price, because this is the one that Ivy always trained on. So let me just show you where you can find your rate of returns on your assets here. So give me a second here. So I just went up on the mutual funds. Okay. So scrolling down here a little bit, under these tabs, you got domestic stock, you got international stocks, you got taxable bonds, tax-free bonds, and then you got your money markets, and then your 529 plans. These are your tickers here, your investment ticker symbols. So if you was to go to Yahoo Money, put in those ticker symbols, and it will pull up that portfolio and it give you the rate of return on that portfolio. But as you can see here, it gives you the rate of return. So let's look at the tabs up here. You got the fund name, like for instance, this one here is capital appreciation. You got your year to date rate of return. So in this case here is 5.7%. You got the monthly year to date. You got your 1, 3, 5 years, and then you got your 10-year inceptions. Okay. So let me sort this real quick. Okay, so now look at this. Health science. Let's click on this guy here. Well, before I do that, look at the different type of portfolios. Look at your 10-year since inceptions. This is your rate of return. 16.43% right now. 15.5. And so on and so on. Okay? So you can get investments of 8% or better. Now, the health science, and I don't know if T. Rowe Price opened it back up to the public, but they just closed it. And so Mr. Stokes had sent out like a public announcement to everybody, my econ associates, to say, hey, everybody need to get into this health science portfolio. At the time, the portfolio was 19.57%. So I managed to open up a mutual fund under that portfolio, where actually I opened up a mutual fund and 3 IRAs under this health science portfolio with a rate of return of 19.57%. Now, if you apply the compound the rule of 72 to that, that means whatever money I have in that investment, my money is doubling every 3.5 years. Remember, you take 72 divided by the interest rate equals the years your money will double. All right? So let's go into health science. Okay? So it gives you a quick snapshot here as far as how the performance is doing. Every portfolio have its objectives, right? And you can read its objectives as you can see here. This objective is for long-term capital appreciation. Okay, but it'll give you some demographics as far as what its objectives is for putting that portfolio together. Under performance. All right. Remember that 1, 3, 5, 10 year since inception? It'll tell you what it's been doing within those time frames. All right. So as you can see here, since inception, 10 years or better, it's been performing at 16.43%. So this is a pretty good stock here. I'm glad I got into it when it was 19.57%. But here's the thing. Vanguard and Fidelity, they had the same portfolio. Now the rate may be a little bit different, but I can guarantee you it's going to be 8% or better. So just because you can't get the portfolio in T. Rowe Price, you can go over to Fidelity or Vanguard and look at their portfolio under that same ticker. Okay? Under composition. All right. So now this is going to show you what companies make up this portfolio. So as you can see here to your far right, these are the different companies, and what they'll do here in T. Rowe Price, they'll list the top 10 so they can get the max performance out of this portfolio. So as you can see, you got Aetna, and you got a few other. What you don't see here is they have roughly close to 100 companies that they pull from to make up this portfolio. So if one of these companies don't perform well, they'll go right back into that pool and find another one that is performing well and put it in their top 10. So this is the breakdown and the diversification of this portfolio. So the biggest chunk is in services. The next big chunk is in biotechnology. Then you got 21% in pharmaceuticals, and then the rest of it rounds out into products and life science. Okay? So again, it uses the top 10 largest holdings for the performance of this portfolio, but they have 100 of holdings that they can pull from in order to keep the performance of the portfolio up. All right. Money management. This is the name of the money management company that's managing that portfolio. Okay. These are the folks that are managing it. It's their job to make sure it's getting its max performance for your investments. Okay. All right. So right here where it says expense ratio, this is what they charge, or the money firm charges to manage that portfolio. So it's a 0.77%. Me personally, I don't have the time to go in and be watching the market go up and down. Do I need to move it? This, that, another. I'd rather pay the small amount of fee for the money market firm to do that for me. Okay? And in the long run, they're working for you anyway. So it's to their best interest to make sure that you're getting the best gain on your return. If you're not, that means they don't get the 0.77% for managing your portfolio. They know if you don't make any money off your investment, they don't make any money. All right? So this was a mutual fund, and you can do an IRA as well. Minimum amount to open up a mutual fund, $2,500. Okay. If you want to do a monthly allotment or a monthly contribution to it, it'll require a minimum of $100, a minimum. To open up an IRA, all you need is $1,000 to open up an IRA. And the same thing for there. Minimum contribution to it is $100. Okay? So let's go back here to mutual funds under historical performance. Now, on that slide, on that quadrant 3 slide where we talked about bonds, I didn't update that slide, but let's click on taxable bonds. Okay, so these are your bonds here. You got the U.S. Treasury long term. You got the corporate income, spectrum income. This is where I was showing you that you can get 5% or better on municipal bonds. This is what banks are using. When you deposit your money in the banks, this is where the banks are pulling from. This is one of them. But they probably also have other portfolios to where they pull in from domestic stocks and international stocks. But they also pull in here from taxable bonds as well. All right. Let's go up on the international stocks. All right. So you got global growth stock topping out at 16.6%. You got global real estate, 13.8. You got global tech, 13.9. Excuse me, that's 13%. Let's go on to global tech, because I was eyeballing that at one upon a time. Let me go up on the composition here. Okay, so under this portfolio, look at the 10 largest holdings. You got Amazon.com. You got LinkedIn, Microsoft, Priceline, Tesla. Oh, Tesla done jump back in there. Okay.
Y'all all right?
Yeah. So look at the top 10 holdings that you have in this portfolio. All right. So majority of the assets is going into media. Then the second one looks like you got software in there too as well. Got a little healthcare in there, I see too. So under this global technical fund, these are the 10 holdings that make up this portfolio. And I want to say Apple was once in this portfolio before. They done moved around somewhere, and I can't really find them. Let's go back. Let me go up under here real quick. All right, under this one, Global Stock Fund, you got Amazon in here again. You got Boeing, Google's in here. Who else? Got Boeing. Yeah, I said Boeing. J.P. Morgan. So these are the top 10 for this portfolio. Okay. So this is where you can go find investments when it comes to annuities, stocks, and bonds. Okay. So you can go to T. Rowe Price, Fidelity, or Vanguard and kind of find your portfolio to where the only thing here's the formula again. All you need to know is what investment portfolio that I can get that's giving me a rate of return of 8% or better. That's all you need to know. Because if it's not 8% or better, the money is not going to work for you. And we're investing so that money can go to work for us. Okay. All right. So any questions? I'm gonna open this up for Q&A right now. This basically ends the presentation. So I wanted to kind of quickly show you all how investments work, and so that way you can just kind of get a good general understanding of how this all works. Now, to get a little bit more savvy, I highly recommend y'all plug in when Ivy has these investment training. Him and Alvin Curry, they are the top dogs when it comes to investment. Not Cedric. Cedric is trying to learn from them, right? But Cedric is plugging in, so everybody else got to plug in to learn a little bit more about it. Okay. All right, hold on. Let's see. Larry had a question. How do you measure or calculate losses when market drop? You let your money firm do that for you, Larry. That's why I say I don't have enough time. I don't have enough time disposable to me to find out what the market is doing, Now what they'll do is, and I got a ticker set up with T. Rowe Price. I get a daily email, and I got it set up that way to let me know when I'm losing money or when I'm gaining money. But you can set it up to where you can get a notification, right? But let your money marketing firm do that for you. Because if you sit there and try to calculate it yourself, you gonna pull your hair out. That's the best advice that I can give you. That's the reason why you pay those folks 0.77% to do those calculations for you. That's their job. Does that make sense? Okay. Let me make sure everybody's off mute so that way everybody can ask questions voice. All right, so I got everything, and I got the conference call and conversation mode. You can ask questions. Hello out there.
Hello.
Hello. Who's this? Okay, Larry. Let's see what you got. Okay. Can you have a cutoff, right? What do you mean about a cutoff?
When your money drops to a certain level, you want to pull it out. Can you have a built-in cutoff?
That I do not know. That's something that you can ask T. Rowe Price, the customer service. They can pretty much answer the question.
Yeah.
So Larry, I don't make the mistake that I did, because I'm very analytic, and I was already good with my brain. That investment was hard.
Okay.
But if you leave it, if you allow the folks managing that portfolio work the performance for you, they can get those questions answered for you, right? If you try to sit there and try to calculate your gains and your losses, then you're gonna be a little hesitant about putting your money in the bank, because it's set up for long term anyway, right? So all you want to do is put your money in the bank. Put it in your investment and just let it ride, and then let your money marketing firm do the work for you, because they're supposed to make the money work for you. Okay?
Okay, I got you.
Trust me, I had to get over that too, because I didn't know anything about investment. I was like, man, do I got to sit here and got to watch these tickers? I ain't got time for that. But then after Ivy had broke it down to me, he's like, well, Cedric, just let your money marketing firm do all the work. Hey, check this out. Here's a good analogy. Everybody had a coach, right? Kobe Bryant had a shooting coach, right? So didn't it make sense for him to go hire him a coach?
All right, I got you.
LeBron did the same thing. Everybody has a coach that help them. Okay? And this is all we doing here. We getting a coach in the financial world to help us grow our money. Okay? All right, any other questions? Remember now, the question that you don't ask now will cost you later. Any comments, Dan? No comment? All right, go on.
Cedric.
Yes.
Hey, this is Dion Rogers.
Hey, Dion.
Hey, man, I'm gonna have to go back and listen to this again. I understand you got it on recording. How would I be able to go back and review this again?
Well, at the end of this, at the end of the webinar, what I'll do is once they generate the link to me for the replay back, I'll send that out. I'll probably put it out like I did the last time. I'll probably put it out in the team page or what have you, so y'all can get to it.
Okay, sounds good.
Yeah.
Appreciate it.
No problem. All right. Any other questions? Comments? Yes? Yes? No? Okay. So look, what I want to do is I just want to thank y'all for coming out and checking out this training. My whole sole purpose is to try to help everybody gain some confidence about what we do. So that way we don't be shy about talking to other folks about what we do. And so periodically I'll just be putting some together. The next training that I got on deck, and it won't be it'll probably be week after next. It's gonna be tax training. I'm already putting the slides together, but it's gonna be on taxes, and we're gonna talk about the difference between tax credits and tax deductions. Since we're gearing down toward the end of the year, we want to make sure we got a good general understanding about how taxes work in general. All right, so that's going to be the next training, is the difference between tax credits and tax deductions. All right. So if there aren't any other questions, then I'm going to say Cedric is signing off, and we will holler at y'all later, okay? Y'all have a good Sunday.
You too, Cedric. Bye-bye.
Bye-bye.